the $1.9 trillion stimulus may not overheat the economy, but there could be repercussions in the equity market.
Oh, yes, absolutely. I think that what that will do immediately is the 400 plus billion in checks, and also the unemployment benefits, extended unemployment benefits, are going to go into retail. And some of that money will go into a reopened travel industry. You mentioned about Thailand, you mentioned about Australia. These things are going to pick up more. US and UK are probably at the forefront of closing in on herd immunity. And reopening of travel is going to be a big deal in the months to come.
So fair to say just buy on dips because stocks are going higher and higher and higher from here.
Well, look, I think there is a legitimate dip to be bought. I think in the high growth space, but I think that the big show at the moment is still in the cyclicals, in airlines, travel, leisure, retail, and some financials. I think these are probably going to be more immediate performers. In terms of how the market is going to react to interest rates, first of all, I don't think the climb in U.S. Treasury yields is over. As inflation rises, you will see perhaps another 50 basis points in the tens, and that's going to keep things a bit more volatile in the high growth space. The past few days of snapback, I think, is because of some oversold conditions in the prior days. But generally speaking, I think the volatility is likely to remain elevated as we see higher yields coming.
And speaking of the froth coming off some of those stocks, China, you went from overweight to neutral. With the sell-off that we saw recently, is it time to relook at China? I mean, after all, it's looking pretty cheap, 14 times estimated earnings.
Yeah, so we turned neutral in January, basically seeing the credit impulse turning in the wrong direction. And that has pretty much played out nicely. But now we saw this bump up in credit growth in February, but I think that has to do with temporary issues such as, you stay at home throughout the holiday, I guess the borrowing and lending activity gets to go on. And so looking forward, I think the message from the MPC is that they're willing to sacrifice immediate growth for stability, right? And that includes, warnings about property asset price bubble, in the prior months. So I think the direction of credit growth is still likely to be more tepid, and that's going to keep things more rational in the Chinese equity market. But again, like you said, the correction that we have seen so far has been fast and pretty deep, particularly in the high growth sectors, and I think that does present an opportunity already, even if we're not at the bottom yet. I think the bulk of the correction is done.
Yeah, but if we're not at the bottom yet, I guess you never know when you're at the bottom. Nobody has the beauty of that hindsight here as well. But a lot of the stocks which were left behind last year have been coming back, and we've had, of course, tech lose its sheen. And that brings us nicely to the question of the day as well, and it is, how long will tech lose to this so-called value rotation that's been taking place in various markets globally? As I said, this is from the MLive team, the question of the day.
Sure, I think that rotation is not complete yet, right? I mean, in the short term, because of technical issues, oversold or not, you may have, this tug of war. But I think, the estimates, the expectations for earnings for things like airlines and accommodation and, traditional retail and some financials are still pretty depressed. The expectation for earnings out of tech is still very strong. We're just, and that's fine, actually. We're just, pricing it at a higher discount rate, so valuations need to be curbed down. But I think the direction of revision for the cyclicals is still upwards. I think that's quite different in the tech sector.
So Ken, tell me, I mean, what is the sector that you're looking at most closely right now, and why? Close, dear to my heart is travel and leisure.
I think that's the pent-up demand there is absolutely immense, even without the type of subsidies that you mentioned about Australia. But I think those subsidies are coming anyway, right? Because governments want to revive the sector, and so I think they'll get both a bump up in volume and a bump up in pricing, and so the profit margin is going to widen, I think, more than what is being expected now. Aside from that, I think, yeah, by the dip on the sustainable growth sectors like tech and green energy, I think those will come back. Well, I mean, those will prove to be, multi-year 20% plus type of earnings growth sectors, and those are being offered at a discount.
Very quickly, Ken, I mean, I think you're looking at some of those risks that investors are overlooking, and that's the US and the United Kingdom as well, who are doing very well in inoculating their populations, which may mean them achieving herd immunity earlier. And that naturally would perhaps result in a stronger dollar. Tell us about the implications of that.
Yes. So what? Well, I mean, so the dollar has been weakening because the real rate situation in the U.S. has been falling versus the rest of the world. That is being reversed somewhat, and clearly the size of fiscal stimulus in the U.S. is far larger than anywhere else, and so even if it's not a sustained bump up to U.S. growth, it would be very meaningful for this year, right? So I think the pretty crowded short positioning of the U.S. dollar is at risk of being squeezed further, and that means we could see some additional strength in the U.S. dollar that takes capital away from things like emerging markets. But I think over the longer run, the U.S. is still suffering from what we call financial repression, which is basically keeping interest rates lower than it should be, or real rates below zero, so that the large debt load can be digested, and that's and then there might be worries about U.S. credit rating as well. So you put those together, that doesn't give us all that much confidence over the longer run about the U.S. dollar, and so we don't think this bear market is really finished just yet. Dollar bear market, excuse me.
Ken,